Hey everyone, and welcome back to the channel where we demystify the complex world of hard-to-borrow stocks and potential short squeeze setups. Today, we're diving deep into a fascinating ticker that's recently appeared on our high cost-to-borrow screener, SPHL, Springview Holdings Limited. This stock has some eye-popping borrow fees, and we're going to break down exactly what that means, why it matters, and what to keep an eye on. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick profile of SPHL or Springview Holdings Limited. Show SPHL ticker on screen. This is a smaller player in the consumer cyclical/residential construction sector with a market capitalization of just $7.03 million. Based in Singapore, Springview Holdings, through its subsidiary, is involved in designing and constructing residential and commercial buildings, undertaking new construction, reconstruction, and also offering general contracting services like renovation and design consultation. Looking at recent price action, SPHL has seen some upward movement despite today's slight dip of 0.62%. Over the last 5 days, it's up a respectable plus 9.12%, and over the last 30 days, it's climbed plus 23.28%. However, today's trading volume is notably low at just 33,056 shares, especially when compared to its 30-day average volume of 2,086,448 shares. This translates to about 0x its average relative volume today. Show chart of price action and volume. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, when you want to short a stock, you first have to borrow shares from a broker. The cost to borrow is the annualized fee you pay to keep those borrowed shares. Think of it like interest on a loan. This fee is paid by the short seller to the lender, usually another investor or institution. Why does it matter? High cost to borrow indicates that there is either very high demand from short sellers to borrow those shares, or, more commonly in extreme cases, a very limited supply of shares available to be borrowed in the first place. When fees exceed 100% annually, it means a short seller is paying more than the stock's current value per year just to hold their short position. This creates immense pressure. Why this stock is hard to borrow right now. Now let's apply this directly to SPHL. Highlight CTB number. Our data shows the current cost to borrow fee for SPHL is an astronomical 725.5% annualized. That's right, over 700%. Not only is the fee extraordinarily high, but the momentum behind it is also striking, with a plus 163 percentage point increase over just the last 5 trading days. This rapid acceleration in borrow fees signals a clear tightening in the supply of shares available for shorting. And speaking of supply, there are currently only 3,000 shares available to borrow for SPHL. When you consider the estimated float for Springview Holdings Limited is around 1.2 million shares, 3,000 shares is a minuscule fraction. Emphasize LOW borrow supply. This combination of a rapidly increasing, incredibly high cost to borrow and an almost non-existent supply of borrowable shares is what puts SPHL squarely on our hard-to-borrow screener. Our internal composite squeeze score, which factors in CTB level, momentum, borrow supply, float size, and other technicals, currently places SPHL at a 42.1 out of 100. It's important to remember, however, that a high cost to borrow does not guarantee a short squeeze. It can also signify strong conviction from short sellers who are willing to pay a premium to maintain their bearish bet on SPHL. Squeeze mechanics explained. So, what is a short squeeze? It's a situation where a stock's price surges upwards, forcing short sellers who bet on the price falling to buy back shares to cover their positions. This buying creates even more upward pressure, accelerating the price increase in a feedback loop. For SPHL, with its 725.5% cost to borrow and a mere 3,000 shares available, any significant upward price movement could put immense pressure on existing short sellers. They'd be facing massive daily fees and potentially dwindling liquidity to cover their positions. If they start buying back even a small number of shares to mitigate their losses or avoid the high fees, that buying can drive the price up further, enticing more shorts to cover, and thus potentially creating a squeeze. Dilution risk check. One critical factor to consider with any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can often depress the stock price and provide new shares for short sellers to cover their positions or for new short sellers to borrow, effectively neutralizing or even negating a short squeeze thesis, even if the cost to borrow is high. For SPHL, our checks haven't found any recent dilutive SEC filings like SPHL, SPHL3, or 424B in the last 90 days. We also haven't found any recent reverse splits for Springview Holdings Limited in our look-back window. This is a positive sign, as it means the specific headwind for a potential squeeze seems mitigated for now. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For SPHL, given its current hard-to-borrow status, here are a few things to keep a close eye on. First, continue to monitor that cost-to-borrow fee. If it continues to climb from its already high 725.5%, or if the number of shares available to borrow drops even further from the current 3,000, that's a significant indicator of increasing pressure. Second, watch for any substantial increase in trading volume. Remember, today's volume is incredibly low compared to its average. A sudden surge in buying volume, especially on green days, could signal a shift in sentiment or active accumulation. Also, keep an eye on the broader residential construction sector in Singapore for any news or catalysts that could impact Springview Holdings Limited. SPHL Springview Holdings Limited presents a fascinating case with its astronomical 725.5% cost to borrow and extremely limited borrowable shares. While the current low trading volume means liquidity is thin, the underlying pressure from these borrow metrics is undeniable. As always, this information is for educational purposes only, to help you understand the mechanics behind hard-to-borrow stocks. If you found this breakdown of SPHL insightful, please hit that like button, subscribe for more in-depth analysis, and let us know in the comments what stocks you want us to research next.